Brad Williams, Frugal Finance, swaptions. We're going to start off talking about credit swaps. A credit swap is a privately negotiated over-the-counter derivative designed to transfer credit risk from one counterparty to another. The payoff of a credit swap is linked to the credit characteristics of an underlying reference asset, also called a reference credit. Credit swaps enable financial institutions and corporations to manage credit risk. The market for credit swaps has been growing rapidly in years. The ISDA survey of the market shows that the size of the market, which was less than $1 trillion in notional amounts in 2001, grew to exceed $17 trillion by the end of 2005. So here it is, 2024, and this number is staggering. Credit swaps take many forms. In a credit default swap, two parties enter into a contract whereby Company A pays Company B a fixed periodic payment for the life of the agreement. Company B makes no payments unless a specified credit event occurs. Credit events are typically defined to include a failure to make payments when due, bankruptcy, debt restructuring, a change in external credit ratings, or rescheduling of payments for a specified reference asset. Remember the financial crash? Credit swaps? Well, here we go. Have we improved the terms and the structure of credit swaps legally? Well, it's called counterparty risk, and this counterparty, they waggled, they used every means possible to avoid these payments. Call it fraud or legal maneuvering, whatever you want. We had that nasty crash in 2008, 2009. If such a credit event occurs, party makes a payment to the first party and the swap then terminates. This was a serious problem. Due to legal challenges, whenever there's a legal argument, clearly the wording is wrong per these contracts, there will always be someone trying to pierce the contract. There are attorneys out there, and that's their job. They're going to try to pierce whatever that contract is to avoid a default. All right. In other words, as a counterparty, you never want to have to pay your other party due to something. Goldman Sachs is not going to pay Bank of America. They're both counterparties to one another. If they think that their credit swap was valid, B of A says otherwise, and they're going to go, the contractual obligation states this, and then the banks are going to argue until someone decides otherwise. But needless to say, the structure of credit swaps has changed over the years by default. Why? If they don't, then they lose their appeal. The size of the payment is usually linked to the decline of the reference assets. In a total return swap, two companies enter an agreement where they swap periodic payment over the life of the loan. Company C, called the protecting buyer, makes payments based upon the total return, coupons plus capital gains or losses, of a specified reference asset or group of assets. Company C, protecting seller, makes fixed or floating payments as with a plain vanilla interest rate swap. Both companies' payments are based upon the same notional amount. The reference assets can be almost any asset, index, or group of assets. Among the underlying assets of a total return swap are loans and bonds. Total return swaps have numerous applications. For example, total return swaps enable banks to manage the credit exposure resulting from their lending activities. Consider a Milwaukee bank that lends $10 million to a local brewing company at a fixed rate of 7%. This interest rate charged by the bank includes a built-in risk premium to account for expected increases in the brewing company's credit risk over the life of the loan. If credit risk unexpectedly increases, the market value of the loan and asset to the bank will fall. To hedge this credit risk, the bank can enter into a total return swap. Assume that the life of the swap is 1 year, with a single exchange of cash flows at maturity and a notional principal of $10 million. Assume also that the swap is structured so that the bank pays the swap dealer a fixed rate of 9% plus the change in the loan's market value. In return, the bank receives 1-year US dollar SOFR. Assume that over the course of the following year, an increase in credit risk causes the market value of the loan to fall, so that on the swap's maturity date, the loan is worth only 95% of its initial value. This is where the problem is who is reevaluating, who's reappraising this value. Under the terms of the swap, the bank owes the swap dealer the fixed rate of 9% minus the 5% capital loss on the market value of the loan for a net total of 4%. In return, the bank receives a floating payment of 1 year SOFR, 8% minus 4% multiplied by the swap's notional principal. This gain can be used to offset the loss of the market value on the loan over the period. Keep in mind, all of this needs to be computed. In other words, you have to have zero arbitrage in these hypotheticals. We'll discuss that down the road. All of these swaps or all of these arrangements, remember I said there's that circle and they're all interrelated? Well, this is not any different. The total return swaps provide protection against loss in value of the underlying asset irrespective of cause. For example, if the interest rate changes, then the net cash flows of the total return swap will also change, even though the credit risk of the underlying loan has not necessarily changed. In other words, the swap's cash flows are influenced by market risk as well as credit risk. The credit default swap enables the bank to avoid the interest-sensitive element of total return swap, provides a protection against loss due to a market risk and credit risk. In other words, the swap's cash flows are influenced by market risk as well as credit risks. The credit default swap enables the bank to avoid the interest-sensitive element of the total return swap protection against loss due to market risk and credit risk. Finally, either credit default swaps or total return swaps entail two sources of credit exposure, one from the underlying reference assets and another from possible default by the counterparty to the transaction. Brad Williams, Frugal Finance. See you soon.